Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Seth Wunder, Chief Investment Officer at Acorns, to discuss how YOLO and FOMO strategies perform compared to buy and hold. Seth, it's great to see you again. Welcome back to Trade Talks.
Thanks for having me.
The deterioration of stock prices was not just about interest rates going up and tech stocks going down. What else is impacting the market?
Yeah, I mean, you've seen lots of companies now report earnings or commentary through the month of May talking about economic slowdown from various points, whether it be consumer discretionary spending, advertising from corporations, as Snap reported, Walmart and Target referring to before. You've seen some of the larger banks start to come out saying that they'll slow loan growth or to think cautiously about the economy. And so the market has really been digesting and reacting to those data points that say economic growth is slowing on the margin. And how to think about multiples and valuations with that backdrop.
How did FOMO and YOLO strategies perform relative to good old-fashioned buy and hold?
Yeah, I mean, listen, it's fascinating. Like you look at the market's high flyers over the last couple of years as we came out of the pandemic. You know, there was a lot of fervor around chasing stocks, multiples getting ahead of themselves. When you look at some of the sub indices, and particularly in tech and so forth, and you're looking at things that are down 50, 60, even 75%. Some of the altcoins in the crypto market have been destroyed and so forth. You know, the overall S&P 500 being down at 1.20, but call it, mid-teens at this point in diversified portfolios doing something similar. The compounded return over time is what most investors are really looking for. And if you sort of reach out and chase a little bit, you get those excess losses on the backside of stock market corrections. And that's where you really sort of burn your opportunity for a good long-term return. So, it's sort of obvious when you look at like, the high flyers versus the steady eddy of the market. But at times like this, it becomes quite evident. And so forth.
Right. So Seth, newer investors presume blue chip stocks are less risky than YOLO and FOMO. And, on the balance, they most likely are. But why is it not only about what you own?
Yeah. So the thing that I think most investors generally get wrong is they either make two mistakes, right? They own too much of one thing, and too much of anything is not a good thing. It's the same we have in our house with our kids and so forth. But then there's also the idea of not owning the right amount of diversification across various portfolios. So like when you look at Walmart, even having one of its worst trading days since the 70s, that just teaches you that the risk is evident right now at the single stock level that is very tangible. And so even thinking that if you're away from sort of the high flying volatile subsectors that you'll be okay, you can still get burned quite considerably. So that's why, like, when you look at like the diversification mechanism, whether it be in the market overall or being prudent in the level of risk that you own of any individual investment, that's where the benefit of compounding will really serve you well over time, because your losses through the downside of this market are much more palatable. I mean, you've seen some like big time investors, whether they be Warren Buffett's or others, write lots of things lately about risk and diversification. I mean, Warren Buffett's got that famous line about like who's swimming without a bathing suit when the tide pulls back. We're in that moment right now. If you didn't have a proper portfolio set up, you're probably regretting a little bit of what this year has become.
And if the economy enters into a recession, and it could already be in one, we won't know until the data comes out, does that assume poor market returns?
Yeah, so that's a great question. I think the average person really confuses, and the media does to some degree as well, that these two things are connected. 100 years of data, there's been 15 recessions, 7 of them. So basically a coin flip, and the stock market's actually been up throughout the period of start to finish of the recession. And that is just not the experience that I think most people are used to when they think back at 2008, when the market went down 37%. The average recession, the stock market really only goes down about 6%. So the pullback we've had so far and what we're discounting would suggest that we've had a lot of bad news that's been put into the market. But it's really important to separate economic backdrop, recession or not, relative to market returns. The thing that's really fascinating right now is if the economy were to slow down a little bit, it actually would take some pressure off the Fed. And I think you'd actually see rates normalize a little bit in terms of their velocity to the upside, and the stock market probably actually do really well. And so there you'd have the unusual feeling of a little bit of economic slowdown actually helps risk assets. So we'll see what the future is, but history says we should be thoughtful about separating the two dynamics.
Right, and to your point, Seth, recessions are part of the normal economic cycle. They do occur. It's not like it's a one-off kind of event, and I think we need to remind investors of that. That they're, the Fed just isn't here to prop up the markets at all times. That recessions are part of that cycle.
Yeah, it's just about wringing out excess, right? I mean, we've all been to dinner and eaten too much food and wake up the next day and feel sick, right? That's not what we're trying to do, right? So the Fed is basically just saying, like, put your fork down. And I think if you think about it from that analogy, it is a normal part of the process. It is relatively healthy. There are pieces of excess in the economy. We all know that. Certainly, YOLO trading and so forth was one example of that. And as the economy normalizes a little bit to a more sustainable level of growth, or even a little bit of a pullback or so forth, it allows us to reset for the next stage of growth over the coming year. So you're right; it is not just a normal historical pattern, but a relatively healthy historical pattern.
All right, Seth, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.